Hello again, everyone. A big thank you to Andy Brogan and his panel there for a timely look at what's going on in Europe. Lots of moving parts, of course, what with coal phase outs, the COVID backdrop, the situation with nuclear, the move to the new Green Deal, and of course the climate law that I mentioned earlier. So we're going to stay with Europe for the next presentation. We're going to hear from one of Andy's colleagues, Victor Manuel Perez, who's Global Integrated Gas and Region Energy Sector Lead, also at EY. We're having one or two little glitches with the technology. It's a tradition that's been established quite firmly since we entered the age of coronavirus. Victor, I think we have you with us. Is that correct? Are you there?
I am here indeed. Somebody has to enable video for you to be able to see me as well. But good morning, Alex. How are you?
So how are you keeping in these strange times?
I'm actually quite well, thank you. Hope you too, and the same for the crowd gathered at their places or offices with us today. It is an honor to be here.
Okay, well, thank you very much for joining us. Victor is going to talk to us about the key role of Europe in the global gas market. It does play a crucial role, being second largest importer of LNG after Asia. We've heard about the impact of COVID on demand and how that's been playing out. And Victor is going to discuss what the European players are doing now about value chain and geographical footprint strategies as we transition to new commercial models. Victor, the floor is yours. The online floor is yours.
I am, and indeed, thanks to all the colleagues who have made this possible. I think you guys are doing a tremendous job in putting all this together. Impressive attendance, impressive list of speakers and panelists, and I'm deeply honored to be one of them. I would also like to thank, obviously, our partners in these events, Exxon Mobil, as well as Hunton Andrews-Kurth. So we are the event's knowledge partner, and the subject of my words today is Europe's role in the global LNG dynamics, and as you just mentioned, Alex, how are players responding to that? So as this is a series of events that started a couple of weeks ago with the APEC series, I would like to link all my presentations to make it a coherent and cohesive story about what's going on in the world of gas and what will happen in the world of gas moving forward, linking the messages from the previous keynote speech on APEC's critical role on LNG in today's about Europe, and in a few weeks' time incorporating the view from the Americas as well to have a truly global perspective. So there are three messages that I would like to share with all of you today. First of all, just a brief recap on the previous session on APEC and how APEC is responsible for 70% of the global LNG demand and is going to account for half of all the growth in the global gas demand moving forward, and how this overrepresents their weight into the global pricing dynamics and price formation globally. Second, how Europe is quickly emerging as the global gas swing market with around 20% of the global gas demand, and with much more radical and fundamental business model changes that we're seeing elsewhere in the world as the fundamentals of supply and demand change dramatically, as well as the footprint and implications for their players. And last but not least, how the players are responding to this is still slightly different or fundamentally different in Europe versus other parts of the world. And we will explore this in a little bit more detail. So just a few messages first to recap on the thoughts I shared with you just a few weeks ago virtually, but from our marvelous Singapore event that Petroleum Economist has put together. So the first and most important message is that Asia will be the epicenter of the world gas and LNG market dynamics moving forward. It only consumes 20% of the global gas demand, but it accounts for 70% of the LNG market, and it will account for 50% of the growth in global gas demand moving forward in the next couple of decades. It is true that COVID will delay the growth statistics for a few years, but the mid and long-term view does not change. And most importantly, this might bring the previously existing oversupply situation into balance faster than we thought just a year ago, as a result of the increasingly amount of rationale into the capacity market with delays in capacity and projects put on hold. And if demand recovers at the rate it could be expected, and weather, which is a really important part of APAC's demand, is favorable, we could very well see next year turning back into an equilibrium point with prices recovering faster than we all think. The biggest source for LNG for Asia is still Asia, with Australia accounting for most of that. Qatar in the middle as the largest LNG exporter, swinging between Asia and capturing a lot of that Asian's gross demand, but still with a foot firmly placed in Europe, given their geographical situation and the arbitrage opportunities that that creates, and we will explore that a little bit further today. And what we're seeing that could emerge as a new source is obviously the US LNG demand and how it will affect the whole mix in Asia. As a result of this, we concluded that Asia, in terms of fundamentals and price formation, is going to experience a very important structural change in the next few years, as all of these sources mix in a different way with different commercial and contractual structures, favoring more short-term hub indexations and a mix of traditional oil indexations with emerging liquid ones, or even those affected by Henry Hub and the domestic US dynamics, which we will talk about a lot in the next session on LNG to power in the Americas. So players, and I'm anticipating what we will discuss later, need to adapt to a much more sophisticated, changing, uncertain, and volatile market, a growth market for both suppliers and buyers, with the emergence of new figures as we discussed. So this was the first point, in an effort to try to link the whole series from Asia now to Europe, and then to the Americas. So if we move to Europe, indeed, the story in Europe is very different. And however, we could say that in many ways is the other side of the same coin. If we look at demand, it will remain stable with moderate growth as the continent continues its transition to a greener economy. In last year, the year before COVID, consumption in the EU went up by 2%, amounting to almost 500 BCMs. And the biggest increase took place in Germany and Spain. And why is this? It happened because fuel switching from traditional coal and thermal-based fossil fuel generation other than gas into gas as coal price differentials with gas plummeting before COVID and CO2 emission costs rebalanced the equation in favor of gas. So it has been a tremendous impact since then in terms of the pandemic in Europe, obviously, and most of all in terms of the social and personal and dramatic issues that many families have lived. But in terms of the destruction of the economic footprint, in some cases much more than conjunctural and probably structural for a few years to come, has resulted in the forced change of habits in terms of transportation and consumption have actually rocketed the demand nature of the continent, with drops in demand expected to be around 8 to 12% across the board just this year. So that is a significant decrease. Future demand will have to rely on economic growth, as weather is not as important in Europe as it is in APAC in terms of the swing and the seasonality. But what's most important is the regulatory thrust behind Europe's economic development and energy policy. The European Union, as you're very well aware of, is bent on transitioning as fast as possible to a much greener economy. And that transition will certainly imply a brighter future for gas that it could have otherwise, as increasing pressure on high emitting CO2 thermal generation sources will create significant room for gas, as it is absolutely necessary to also support the growth of renewables. And in fact, that has been the case. In the last 5 years, gas power generation in Europe has increased from 15 to 20%, whereas renewable generation has increased from 14 to 21%. So it's not gas versus renewables, it is gas and renewables. And a lot of players have realized this, incidentally, as we will discuss later. When we move into supply, the situation in terms of supply is slightly different than Asia, but has some of the same dynamics as well. Europe's supply mix is characterized by a few factors. First, a dwindling European gas production, which has been declining for almost 15 years, with North Sea outputs being on a constant decline, and will continue to do so by 25% in the next decade. We know that Netherlands' Groningen growth field is expected to phase out in the next decade, and the UK's North Sea is also on their natural decline path. Residual productions elsewhere will not be able to cover for this. And the one that will still hold its ground is Norwegian gas production, which is expected to remain stable. So this creates a significant need for gas, even if demand is going to become or is going to remain stable, that will need to be filled by the traditional equilibrium of sources in the European gas demand. And those are pipeline deliveries, mostly from Russia and Algeria, and global LNG dynamics. So those are the two sources that are going to make up for the equilibrium and price formation in Europe moving forward. We are, however, seeing changes in those two sources and the dynamics in those two sources, which will have a significant impact in Europe. And I will focus on LNG as this is a conference on LNG. We are increasingly seeing a couple of interesting dynamics that will affect price formation in Europe moving forward, as LNG is on the margin and determines the marginal pricing across Europe nowadays, with certain differential in some markets, but that's the reality. So the sources for LNG are shifting and are increasingly incorporating gas from the US, whose price fundamentals are significantly different than previous or existing LNG sources that were already in the markets. But most importantly, as more LNG from more sources has become available in the continent, and that has mixed successfully with pipeline gas, creating liquidity around hubs, customers themselves have moved into a new area of risk acceptance. So whenever customers a few years ago were only accepting prices that were fixed under a certain indexation formula on a long-term basis, they are now much more willing to accept market prices for their gas, especially, of course, in the last few years and with the last prices that we've observed pre-COVID, which has in turn created a virtuous circle of more liquidity, more products, more agents, and marginal pricing that it's much more dynamic than it used to be just a few years ago. So this risk acceptance by clients, increased liquidity, and obviously the ability to pass that through on to their respective customers and clients has ripple effects on the players' strategies as well, as we will discuss later. In terms of the fundamentals of price formation, more or less around 70% of gas in Europe is now priced at the marginal hub dynamic pricing, but there still remains a significant amount of oil indexation, especially in some markets. We are, however, moving, and we've observed a tremendous change in just 2-3 years in terms of indexations related to mostly TTF or TTF associated or correlated price hubs, such as PSV, PVB, or many others. And we now find ourselves in a very different market than just a few years ago. What we thought would take several years to develop, it's actually taking less than that. And we are seeing the majority of contracts with B2B clients in certain markets, even in traditional oil index markets, now being referenced somehow to TTF or TTF plus levels that would reflect the country's level. So this is a very important change in the European gas dynamics that will affect also the contractual and commercial relationships between sellers and buyers moving forward, as we will see new sources of commercial structures coming up, a lot more balance sheet financing behind all this, and risk acceptance that will imply as well much more sophisticated policies to handle and commercial efforts to drive that through. So that is what is going to happen and is happening as we speak in Europe and the European fundamentals of supply and demand and the resulting price formation. So the third point in my thoughts that I would like to share with you today has to do with how the players are responding. What we discussed just a few weeks ago for Asia was how the Asian players, or those players who want to play in the Asian new environment, need to rethink their value chain footprint by investing in places they hadn't thought about, such as downstream or access midstream infrastructure, which was the case in Europe a couple of decades ago, and how, without exception, being sellers, buyers, aggregators, or traders, they definitely need to upgrade their operating model, the trading and commercial operating model, deeply reviewing their end-to-end processes, their capabilities, their IT and digital enablers, as well as their internal fundamentals of transfer pricing and incentives, and these across the front, the middle, and back office. Europe has slightly different implications, or very fundamental different implications for their players, and players are responding in what we could say 2 different ways. Well, first of all, those players who entered into gas roughly a couple of decades ago as a means to source competitively the gas they needed to sell to their clients or to generate electricity, mostly the utilities, are now realizing that their gas positions are not as strategically important to their business as they once used to be, especially now that their customers are accepting risk in a different way than they used to, and that there's liquidity in the market so that they can take short-term positions, both in with regards to access to infrastructure as well as gas. And as a result, there have been already a few bold moves by several utilities, such as Iberdrola last year, one of the first entrants of the utility world in the gas industry a couple of decades ago, who let go of their LNG contracts and infrastructure positions in Europe, shifting towards short-term sourcing and embracing the new liquidity in the market. And there are others, as we speak now in the pipeline, who are considering these, and very large transactions are happening at the time from utilities following in these steps. On the other hand side, the IOCs that are based in Europe, which of course they have a global presence, on the one hand side, they are following in the footsteps of those who want to play in the global gas and LNG world by upgrading their operating models and trading commercial models, redefining and rethinking their presence in the value chain, investing heavily in both the gas upstream, midstream, and even and especially sometimes downstream presence. So that they are in that sense very much following the same footprint or footsteps that we saw in players willing to play in Asia. But the one thing that separates them from players outside the European Union and in the US as well is the thrust for energy transition. As we see regulators in Europe pushing through with relentless drive for energy transition, and as the fundamentals of demand in Europe are significantly different than elsewhere, IOCs in Europe have had almost no choice but to embrace that energy transition, and within that, gas becoming a much more important and a strategic pillar than it used to be 10 years ago in their portfolios. So we see a lot of, or almost every European-based IOC shifting decisively towards gas. Still, they are, of course, they are investing in oil or associated upstream developments, as the growth is still there, and replenishment alone will imply significant investments for the next few decades. But the growth of gas in the reserves and production mix is going to be phenomenal. In some cases, even unexpected, or by many by many of them. So we see, for instance, CNI, whose gas share will increase from 48% a couple of years ago to 60% by the end of this decade in 2030, or 85% in 2050. So gas is no longer an option. Gas is the lifeline that is going to get them through the next 2 or 3 decades, and a lot of growth is expected from gas, as we discussed last time. Only 40–60% alone in demand, and much more than double than that worldwide in terms of new supply needed into the system. So gas is becoming much more important for all the European IOCs. And the second thing, of course, is that gas comes along renewable in their transition from IOCs to IECs, energy companies rather than oil companies alone. And as we speak, we are seeing the efforts and the new strategy of BP. Shell has been betting on gas and focusing on gas already for a few years, and is now becoming a very sophisticated player worldwide. Repsol has very large energy transition investments and strategic objectives, and so on and so forth. So this energy transition that we observe in the European-based players, both those who needed gas for their customers and activities under long-term take-or-pay, or even in some cases equity gas, including infrastructure, are letting go of that, as this becomes a much more complex, sophisticated balance sheet and short-term oriented commercial business, much more like oil in that respect than utility business, with the complexities added to gas regional price formation as opposed to oil. And on the other hand side, the IOCs, who feel very comfortable in these risk environments, are now embracing gas and adding renewables, this time on a committed path to transform themselves over the next 2–3 decades. So these are the 3 points I've shared with you today. First, recap on how Asia is going to be critical for the world's global gas price formation, as it represents 70% of the LNG demand, and LNG determines the price, the marginal price in many places. How Europe's dynamics are significantly different, as demand will remain stable or with a modest growth, but supply will need to be renewed with new sources, and these new sources bring in more liquidity and acceleration of the price formation dynamics that we've been observed in some northern and western markets in the last 5 years, and driven as well by the customers' acceptance of risk that the liquidity has generated and the low prices have facilitated, and how players have responded to this. Those who still want to play or want to reinforce their gas capabilities and presence everywhere by upgrading their operating and trading and commercial models. Those who don't require a privileged, secure access to gas because it's already available, letting go of those activities, and the European IOCs embracing energy transition with gas at the helm and at the core of that development. So I would have liked, as I suppose most of you, to have shared these thoughts in person and follow up in the nice conversations that happened afterwards. But I remain at your disposal to enlarge or debate any of these points, of course. And again, I would like to thank you all for being there. I'm looking forward to listening to the rest of the speakers and the panelists, and thanking once again Petroleum Economists for this fantastic event. So Looking forward to seeing you in a few weeks' time and completing the world's tour, this time with the Americas.